The 60-40 portfolio is back, but it really never left. Hey everybody, I'm Michael Smith. Welcome to the Lowdown. And today we're going to get into the 60-40 portfolio. So what exactly is that? Well, that means 60% of the portfolio is traded in stocks. 40% of the portfolio is traded in bonds. This is something that has been used in wealth management as a bellwether, well-diversified portfolio for decades. So it is the go-to balanced strategy for wealth management. So the question you're probably asking is, where did the 60-40 portfolio go? Well, last year, and I'm going to reference here a chart. If you look here, bonds, the absolute worst year for fixed income. As a matter of fact, if you look closely, you don't see any other years that comes even to a close second than last year for bonds. So the worst year by far for bonds. If you look over to the right, stocks had the fourth worst year in history as well. So if you combine those two together, that is probably the worst year for the 60-40 portfolio. Now, if you look in this other graph over here, you'll see just how alone it is. If you look at the chart, risk versus reward, and you look at the diagram, you see most of the charts returns are up in high risk equals high reward. In this case, all alone down into the bottom left quadrant, which means more risk for less reward. That's the quadrant you never want to be in. That's where the 60-40 went. So that leads us to our last question. Is the 60-40 still the benchmark? So I'm going to answer this in a couple ways. For one, I think for anybody that's just beginning, getting started, putting money into savings and trying to invest is probably a great benchmark for you to basically wait. It's the long bellwether of diversification. And if somebody's obviously maybe lazy about it, they're just going to set it, forget it, they don't want to come in and manage it, that's probably going to be the best place for you for the long term. However, as you start to build and accumulate wealth, I think the 60-40 is probably not the best portfolio going forward. I think by adding non-correlated assets in the alternative space, and by the way, that's a very, very big space, time for another show, looking at assets that don't correlate, not just with stocks, but recall last year, bonds and stocks all correlated together. That, I think, is the future portfolio and where things are heading and probably going to be the most optimized for the best risk-reward returns. That's it for this week's episode of The Lowdown. I'm Mike Smith, and we'll see you next week.